There are a glut of funds in the market. A right fund can help you achieve your goals in no time. So what is that right fund that you're looking for? We're discussing that in today's Investors Hangout, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me is the CEO of Value Research, Devendra Kumar. Welcome, Dhiren.
Thank you.
My name is Rajesh Lake, and my first question to Dhiren is this. How do I choose the right fund? Is it dependent on my goal, small-term goal, medium-term goal, long-term goal? So let's bifurcate and take it from there.
Broadly, I would say that, you don't have to be very precise. The money which you are likely to need in few days' time, or, maybe a week or 2 weeks, that money should be in liquid fund, and don't consider any other option. This is the kind of fund where the money is invested in such a manner that you will never get a surprise. Okay. The return that you will get on this money will be little higher than your savings bank account. Not little higher, substantially higher, but investors will not notice it, because one, the money is for a very short term. And what difference, the impact of that difference, if you are going to earn 7% instead of 4% on any amount of money for few days only or few weeks only, it will not be meaningful. But the money can be taken out anytime with great convenience. It's a very liquid thing. Money for a year or so to up to 5 years, consider only short-term bond fund.
Which you're terming as
medium term. And that is something which you should think in terms of, and also for a non-negotiable goal, because negotiability of a goal and a non-negotiability goal is a very crucial thing. There are things for which you cannot really postpone your spending. Tuition fee for your child, it has to be honored. By purchasing a house, or the down payment for a house can actually be negotiated by few months or maybe a year or so. Depending on the need, depending on the goal that you're investing, and many a times there are very vague goals, that long-term wealth build-up, or long-term financial security. That is a goal. So that those are different things. But here, consider only short-term debt fund. That it will keep it simple. It will generate more return than corresponding deposit. It will be more tax efficient, because the return that you get from a deposit is taxable. And not only taxable, it is taxable in a very, disadvantageous way, because every year the bank will deduct the TDS. So your capital goes down. Here the whole money accumulates, and you are liable for taxes only at the end of the period. If that period happens to be 3 years and more, then it will be indexed, which means your capital will be adjusted for inflation, and the return over and above the inflation adjusted capital, you will be liable to pay taxes only on that. Third is that the long-term goals, for which you need to consider various options depending on two things, which is very crucial for investors to, and that is entirely dependent on, that varies for investor to investor. One is that how critical is that money, because equity is a volatile asset class, and it turns out to be the most rewarding asset class. So how do you deal with it? Two things which is entirely dependent on you, that how long you have, do you have any experience? If you're a harbinger, if you're getting started, you have never invested in anything which is volatile, you have to consider a different kind of option. Okay. So, we'll get on to in greater detail on that.
Okay. So we've done small term, medium term, long term. Liquid funds comes under small term. Medium funds, we have the
short-term debt funds.
And in the long term, we're talking about the equity funds. And for a first-time investor,
I would like to expand the equity bit, the long-term investor, because many a times, long-term investor, as I was explaining, that two things matter most. In fact, the criticality of money. So, and your experience. So first-time investor, if you have never invested in anything which is volatile, which is market-linked, which can go up and down, and that actually has the highest potential, return potential, equity proves to be the best performing asset class over any long time period, which I would like to quantify as 5 years and more. So that is, get going with that. Start with a balanced fund for anybody who has no experience. Then only consider, graduate to the next level, in the sense that once you have invested in the market for 2-3 years, you have done it, and then comes the criticality of money. Because if you are investing for the first time, and that money is extremely important. It will actually cause a huge difference. So your risk tolerance is very much dependent on that. If you have accumulation of 2 crore rupees and a 10% market decline, you will be sad about it. Your 2 crore becomes 1 crore 80 lakh rupees, but it is unlikely to devastate your plans. But it is unlikely to derail your plans or your critical financial goals. But think of somebody who is investing 5,000 rupees a month, and 3 years accumulation of 1,80,000, which has become 2,40,000 rupees, and that can translate into something which can be a life-changing thing. So your attitude to that money, the decline in the value of that money is very different as compared to the scale of it. So how important is that money, and how old have you been in this? Because any kind of it in the market, it's very difficult to learn from other people's mistake, other people's experiences. If I tell you that it will be all right, just remain invested, and 5-7 years you will be much better taken care of. You'll be able to beat inflation. You'll be able to beat fixed income return, and this accumulation will be substantial. But if you haven't experienced it, once you see your value going down by 10%, all your accumulation which you have never been used to, your attitude is different. You will behave in a manner which will be irrational, which will be disadvantageous. You will actually generally end up buying high and selling low, and that turns out to be a huge put off, and that is what actually has driven away investors from equity over a period of time.
But nobody has experienced this new peak of 35,000
yes,
as recent as Wednesday. So in this scenario, is there anything that an investor should take care of, or should withdraw, or should he remain the way and continue with the SIPs?
Oh, continue with your SIPs and make sure that you are in the appropriate kind of fund, because most investors are in the wrong kind of vehicle.
No,
and
that's
which
another discussion we
yeah,
have.
no, but I would say that don't do anything. If you are following the principles which I have just stated, that things you are invested in the right kind of fund, you don't have to do anything. If you are in the inappropriate fund, revisit that, change that. Otherwise, you will get a nasty surprise. Because if you are a long-term investor but a new investor who invested in small cap and the money went up by 50% in 2017, and now you are feeling all confident, and if that money goes down by 40% in another 2 months, you will be in for a surprise. It will scare you, and if it goes down any further, it will drive you out of the market in a manner that you will never be able to come back again in future. So being in the appropriate kind of fund. So as I was telling, that if you're a first time investor, move to a balanced fund. If you have gained from any of the things, if you are a moderate sized, even an experienced investor, be in multi-cap funds, because you will be saved of the bother to rebalance that, whether you should be investing in a small cap or a mid cap or a large cap or any thematic thing right now. Interest, be in a more diverse vehicle, because you have 2-3 things. One is that invest gradually to average it, invest your long-term money, and make sure that you are adequately diversified. These are the only 3 tools in the hands of an investor to de-risk himself.
And is there at this juncture one should think about systematic withdrawal also, or no need to do that?
If you are getting closer to your goal, because those are entirely independent, individual dependent issues. If you are getting closer to your goal, then by all means start it. You should invest regularly and you should disinvest regularly for your needs. Otherwise, just because the market is at 35,000, should you act? No, because we were actually worried about the market even when it was at 25,000. It took 7 years for the market to regain its 20,000 value, peak, which it achieved in 2007. So market corrected, struggled, new government. So we have seen there are a lot of ups and downs. Markets move in a very unusual way, when you least expect it. Last year everybody waited for the correction and the market went up by nearly 25-30%, or at least the fund investments. So don't do that. Have your principles, manage what you can control, and you can't really predict the market, and I don't think you can guess the market to profit from it.
And also investors, I think, need to keep their eyes and ears open these days. As you said, and the funds which are not doing appropriately, you should get
No, I would say that every fund is doing what they are supposed to do.
Okay.
But you don't need to really look at all of them. Most investors' need can be fulfilled by 5 kind of fund. Liquid fund, an ultra short-term fund for your immediate needs. The short-term bond fund for your medium-term needs.
Correct.
And if you are a new investor, one balance fund. If you are a new investor who needs to invest for saving taxes, a tax-saving fund. Maybe these 2-3 kind of funds can fulfill all your needs. The remaining, we discussed in a previous hangout session the number of categories which the regulator has permitted. 32 kind of open-end funds. Let it be, but your all critical needs can be nicely met with these 4-5 kind of fund, and you don't really need to look further.
So Dhirendra is saying, keep it simple. 5 categories that can serve most of your needs are liquid funds, short-term debt funds, balanced funds, ELSS and multi-cap funds. So invest wisely and continue, as Dhirendra is saying, with your SIPs. We move on to the question and answer sessions. Godrej Wadia has written in saying, is it a good idea to invest in closed-end funds, as fund managers can manage them better with less fluctuations compared to open-ended funds where purchase and redemptions happen frequently?
No, it's an avoidable vehicle, because to me the biggest advantage which an investor has when investing in a fund is to be able to average his investments. The other is that when you are investing in a fund, looking all that you have is past performance, and in case of a closed-end fund, you don't know anything. A fund is getting started, it is telling that it will manage your money like this, but it has not demonstrated anything that, because closed-end funds by its very design, they open for a period, take the subscription money, and your money will be stuck for the tenure of the fund. It will be a 3-year fund, 5-year fund, and then you have to see how it happens. You can't take your money out in between. So once in a while there could be an opportunity that, but it's very hard to guess that. I think investors have these 2-3 things. One is that they look at the past performance, and not in terms of look at the past performance and not look at the returns, but how this fund has behaved in different kind of conditions, good market, bad market. And I think the biggest thing, the biggest factor which I look for in a fund, not that how it has done in a good market, how it has done in a bad market, because that is the single most differentiating factor in the long term prospective performance of a fund. In case of a closed-end fund, you can't guess that. The other is that, of course, what he's referring to is that the fund manager has a greater predictability, he has to worry less. But there is absolutely no evidence that closed-end funds have done better than open-end funds, even when they got money and they don't have to worry about day-to-day redemptions and purchases as the case is in case of an open-end fund. There is a third factor which goes against closed-end fund. Mutual funds make money by managing a fund, and in case of a closed-end fund, they are less interested, because when you run an open-end fund, you do well and you get more money. In case of a closed-end fund, you do well, and at the end of the term, the investor takes his money and goes away. There isn't a great incentive. So these things actually come to my mind, but once in a while there could be a closed-end fund which does well. But most investors are better off investing regularly in a good open-end fund.
Okay. Anjani Kumar has written in, I'm a beginner and I want to invest a small part of my salary in a mutual fund. Please suggest what type of fund I should select. I can answer.
Yeah, you can answer that based on our prior discussion.
Balanced fund.
Invest in a balanced fund. Invest in your balanced fund for at least 5 years and more. Invest regularly. Don't panic if market corrects. And I will say what I would like to use this opportunity of this question in terms of explaining why balanced fund and what are they. A balanced fund invests 65% of the money in diversified equity portfolio, remaining 35% in fixed income like bonds and government bonds, corporate bonds, and they rebalance on a day-to-day basis. By virtue of investing 65% and more in equity, the tax treatment of a balanced fund is like that of an equity fund, which is you hold your balanced fund for 1 year and more, all the gains are completely tax-free. then 35% of the money which is in fixed income, even the return from that becomes tax free. Rebalancing, which the fund manager does, that actually takes the benefit. If the market goes up and down on a day-to-day basis, which it does, so the fund manager is rebalancing it. So many a times if the market goes nowhere, but it goes up and down in the interim, a balanced fund has the potential to generate more return than an all equity fund, because they will be profiting on a day-to-day basis without any tax implication. Third is that, when the markets go down, balanced funds fall less because of that 35% fixed income. If the market does well, balanced funds are able to participate reasonably. So it is, balanced funds don't scare investors as much as an all equity fund. That is why we keep insisting on
a lot of win-win situation.
Yeah, so I think it's a very favorable thing. It's a very important thing that any investor should get started only with a balanced fund. Otherwise, one runs the risk of getting scared by the volatility of equity and being driven out of the market.
Okay. Our next question is from Anil Chaudhary, and he says, if I have to increase my monthly investment in the same fund, is it better to add to my existing SIP or create a separate SIP in the same folio?
It doesn't matter. Technically, there is absolutely no difference. You can just increase the amount or add another, initiate a new account in the same folio. You will not have to do any more housekeeping. And the tax treatment, the tax implication in both cases is the same.
Very critical question. Next one, Naina, or is it Ninad? Please do pardon me on my pronunciation, but I reckon it is Nainad. Is there a big correction? If there is a big correction and the market falls by, say, 50%, how will the fund manager handle it? To honor redemptions, wouldn't they be forced to sell low and book losses?
Yes. Mutual fund managers will act entirely in the manner the investors does. Mutual fund manager is a slave of the investor. If markets fall by 50% and if investors redeem their money, the fund manager will have to sell. If the markets fall by 50% and investors don't sell, the fund manager will not have to sell, because they have to sell stocks or sell anything in the market only to honor redemption, and it is your money which he has invested. You want your money back, he will have to sell. Then comes, will there be a sell-off of that kind? If there is a 50% decline in value, will many investors, in many funds, there is a possibility. The way it is not a theoretical, it is not a hypothetical situation. We have seen this situation exactly, in 2008 we saw this. Markets went in a tailspin and went down by 50%, and many funds by 70%. The small caps and the mid caps went down. So if you had 100 rupee invested in January 2007, what was left by December was 30 rupee. But then it took no time, next 1 year, that reduced 30 rupee became 110. So those kind of aberrations happen. Markets don't produce the kind of, when we say that equity produces superior return over a long period of time, it never goes up nicely in a straight line. It goes with a lot of ups and downs, and that was a very severe situation. But I would say that fund managers deal with it in multiple ways. One is that they always have a cash position, so 5-10% is generally cash. Then comes, there is certain kind of, if the fund gets larger, assuming that a small cap fund or a mid cap fund gets larger, they try and keep more liquid kind of stocks in the portfolio which are easy to sell. And the third situation is that, if the fund manager gets large redemptions and he has a lot of illiquid position, because the fallout of a market decline of this kind is that even the liquidity dries up. Today the market will be very liquid. In a rising market, when people are enthusiastic, optimistic, there are a lot of money flowing in. So you'll find that many stocks in which the average trading volume used to be 50,000 shares, today there will be 2 lakh shares. So if you want to buy or sell, it is not that difficult. When the market goes into a tailspin, it will be very difficult to sell. There won't be many buyers. That's why the market has fallen, and that actually any subsequent sell leads to sharper fall even further. And those are the opportunity I think fund managers have to worry about. There are funds which will suffer more, and yes, if a lot of investors pull out money, the short answer is funds will have to sell, and it will lead to it will precipitate even further fall.
Dhananjay asks, can a retired person contribute to NPS? Are there any limitations? What tax exemptions can be claimed in such a case?
The tax exemption is available to everybody in NPS, which is under section 80C 1.5 lakh, 1,50,000 rupees, and 80D additional 50,000 rupees. So an annual contribution of 2 lakh rupees can be made in NPS, which will be deducted from your income. Good news is that effective 1st of November 2017, the rules have been revised based on the kind of situation we see that a lot of people post-retirement are able to work. They should be able to contribute. So now the minimum entry age in NPS is 65 years, and you can continue your contributions up to the age of 70 years. So this is the revised normal of the retirement benefit system that we have, that it has recognized that people might get into a job or can continue a job and contribute to their pension up to 65, and keep contributing till 70 and gain entry till the age of 65.
Okay. How does this actually work? The 5-year corpus would be then divided over the number of years?
No, it's very straightforward. You if you want to save 5 lakh rupees a year, or 40,000 rupees a month in NPS, you keep investing, and say you are 63 and you start investing now 40,000 rupees. So you'll get a tax break only on 2 lakh rupees, your contribution, and so that will be deducted from your income for computing taxes, and all your accumulation up to 70 will be ready for either you can mount a withdrawal plan from that, or you can convert 60% of that into annuity, and rest of the money you can take out.
Krishnamurthy has written in, should we hold ELSS funds for a long time or redeem them after the lock-in period ends and invest in other funds for more returns?
Investing in other funds for more returns, I don't know how, that won't help. You should redeem your ELSS after lock-in, only if you find that the ELSS fund, the tax saving fund, is not doing well. Otherwise, I don't see any reason. And there is another reason why sometimes people redeem their tax saving fund. End of the March, you're getting close to the end of the March, and you find that you don't have enough liquidity, you don't have money, you have not been able to save enough, and if you don't make that investment, you will be liable for higher taxes. So in that case, sometimes it might be desirable to redeem your money and invest that money again, so that you are able to take the tax break, because tax saved is money earned. Otherwise, so only 2 situations in which you should redeem your money in ELS, tax saving fund. ELSS is equity linked saving scheme. So the money which you invest in them, in these funds, they are locked in for 3 years. So 2 situations in which you should redeem your money from the funds which are out of the lock-in, not performing well, or you have a cash crunch and need to invest for saving taxes.
Nilesh Nishar has written in saying that I had invested in long-term debt funds at the time of demonetization, but have earned only around 3 to 3.5% since then. Should I redeem them or wait for another 1 or 2 years?
Yes, if you are a fixed income investor, these are relatively low risk investment, but most of them got their call right, or called wrong, in a sense that everybody was expecting that there will be rate cuts, and we haven't seen any. And so I would say that yes, holding it for 2 to 3 years will enhance your return. The worst might be over. But for all other investors, I would say that what I was discussing at the outset in the initial discussion, that all risk averse fixed income investors by design are risk averse. They don't want to, and even these funds, which has not given great return, but at least has protected your downside. 2 to 3% return is completely different thing than 10% decline in value. Of course, it is not 9%. Ideally, I would have expected that if most of the things would have fallen in place or as expected, these returns would have been about 10-11%. But it will keep happening. 2 to 3 year time frame, you will have decent return. And if you want to avoid any such thing in future, don't take chances. Be conservative. Be it with a short-term debt fund. It will get you predictable 8.5%. During this period when these dynamic bond funds have given 2 to 3% return only, those funds have given 7.5, 8.5, 7 to 9%, return in the range of 7 to 9%.
We have a last question now. When are the expenses deducted from a mutual fund investment? Are they adjusted from the NAV?
Yes, all expenses are deducted from the NAV on a day-to-day basis, and it's important for funds to actually deduct that expense on a day-to-day basis, because many investors are coming in and going out of the fund every day. So and it is adjusted in the NAV, because the NAV of a fund in India also happens to be the price of a fund on which investors buy and sell the fund. So they are deducted on a daily basis, and it is reflected in the NAV every day.
Dhiren, that's all we have in today's program. Thank you for your valuable advice. And as Dhiren said, keep it simple when selecting a fund for yourself, and keep investing. Till next time, I'm Rajesh Lake along with Dhiren Kumar saying goodbye to you.